The big elephant in the room.
Investors were expecting inflation to stay high.
Inflation is still a problem.
This is the first slowdown in core inflation we've seen in 6 months.
But you said the leak isn't fixed.
Better than feared, not necessarily good.
Is it truly a sign that things are turning around, or is it just like a temporary blip?
Which is significantly higher than the Federal Reserve's 2% target.
So how should we really interpret this slowdown?
Most economists believe.
All right, so we're going to do a deep dive on this CPI report that just came out.
Okay.
It's been making some waves, and, I think it's interesting. The way I kind of look at it is like, imagine you've got this leaky faucet, and you're worried it's going to turn into this, like, full-blown gusher.
Right.
And the market was kind of feeling like that, I think, before this report.
Yeah, definitely. There was a lot of anxiety going into it.
But then, like, right after those numbers came out,
Yeah.
it was like, bam! The S&P 500 jumped, like, over 1% within minutes. And then the bond market went crazy.
Yeah, you're right. It was like everyone was expecting just a terrible report card.
Yeah.
And they just sighed in relief when it turned out to be just average, right? Like looking at it from the outside, you're thinking, huh.
Yeah, exactly.
Why is everyone so excited?
Exactly.
Okay.
So that's exactly what we're going to do today. We're going to try to figure out why everyone's so excited about this CPI report and if it's actually like all that.
Right. Yeah. Is it really worth all the hype?
First things first, just a quick reminder. The CPI, or Consumer Price Index, is basically just telling us like how much more expensive everything's getting.
Right.
It's how we measure inflation.
Inflation's been really sticky.
Right.
And investors, I think, were bracing for more bad news.
Yeah, and then they see that the drip has slowed a little bit.
Yeah.
Not fixed,
Right.
but it's dripping less.
Yeah.
And everyone's celebrating like they won the lottery.
Yeah.
Stocks are up. It's crazy.
It's really a case of like better than feared, not necessarily good.
Right.
Market was really prepared for a deluge of bad news.
Yeah.
So even just a slight improvement feels like a huge relief.
So it's kind of like dodging a punch.
Yeah. Yeah.
More than actually winning the fight.
Exactly. Yeah. The bond market, for example, is very sensitive to inflation expectations.
Okay.
And before the report, investors were expecting inflation to stay high.
Right.
So when these CPI numbers came in slightly better than expected, bond yields fell, prices jumped up.
Okay.
It's a bit of like everyone breathing a sigh of relief.
Okay, so let's break down the actual numbers of this December CPI report.
Yeah.
What are we looking at here?
So the headline CPI, which includes everything, rose 0.4% month over month.
Okay.
That was right in line with what analysts were predicting.
Got it.
But I think the real attention grabber was the core CPI, which excludes more volatile food and energy prices.
Right.
That came in at 0.2%, so slightly lower than anticipated.
So that's what got everybody excited, a 0.2% increase.
Well, it's all relative, right?
Right.
Remember, this is the first slowdown in core inflation we've seen in 6 months.
Right.
So, it suggests that maybe, just maybe, the measures to combat inflation are starting to gain some traction.
But you said the leak isn't fixed.
Right.
So how should we really interpret this slowdown?
Yeah.
Is it truly a sign that things are turning around, or is it just like a temporary blip?
That's the million-dollar question.
Yeah.
So, while a slowdown is encouraging, I think we need to keep things in perspective.
Okay.
Core CPI is still up 3.2% year over year, which is significantly higher than the Federal Reserve's 2% target.
So we're seeing progress, but it's slow progress.
Yeah.
And what's the key takeaway here?
The biggest lesson is don't get swept up in the market's short-term mood swings.
Okay.
Just because investors are feeling relieved today doesn't mean that the underlying inflation problem is solved. It's like celebrating because your leaky faucet is dripping a little less while ignoring the fact that it still needs to be fixed.
Yeah, that's a great point.
And
it's easy to get caught up in those headlines. So let's dig a little deeper into the specifics of this report.
Okay.
What's actually driving these price changes?
Yeah.
Like what's getting more expensive, what's getting cheaper?
It's a bit of a mixed bag, actually.
Okay.
So you see some areas that are showing signs of improvement. Others remain stubbornly high.
Okay.
For example, shelter costs, which are a big chunk of the CPI, actually decelerated in December.
Oh, that's good news for anybody looking to buy a house or rent an apartment.
It could be, but it's important to understand the nuances.
Okay.
While the overall pace of the increase has slowed both rent and owner's equivalent rent,
Right.
which is basically what homeowners would pay if they were renting,
Right.
still ticked up from November.
Okay.
On the other hand, we saw some significant price jumps in other areas.
Okay.
Airfares, for instance, surged nearly 4% in December alone.
Oh, wow. So much for those post-pandemic travel bargains.
Yeah, that pent-up travel demand is definitely putting upward pressure on prices.
Okay.
And then there's the used car market, which continues to be a roller coaster.
Yeah.
Prices rose again in December, although at a slower pace than earlier in the year.
Used cars have been all over the map the past few years. And it's not just the big ticket items that are getting more expensive, right?
No.
You mentioned food prices earlier.
Absolutely. Food prices, particularly for groceries, are a major concern.
Yeah.
They've seen their biggest jump in over a year,
Wow.
which is putting a real strain on household budgets.
Yeah.
Some items like eggs have experienced truly eye-popping increases.
I think we can all relate to that feeling of sticker shock at the grocery store lately.
Oh, yeah.
So we've got this mix of rising and falling prices. But the overall picture is that inflation is still a problem.
Well, it means we're all feeling the pinch in different ways, whether it's at the gas pump, the grocery store, or when we're trying to book a vacation. These rising costs are impacting our daily lives and our ability to save.
Yeah, it's easy to feel a bit helpless when you're faced with these larger economic forces. I know we have some additional content that can help our listeners navigate this challenging economic landscape.
We do. We've put together a very insightful YouTube video called 2025 Stock Market: What Smart Money Knows That You Don't.
Perfect.
It's packed with information and tips to help you understand the market and make smarter financial decisions.
Definitely check it out. Now let's shift our focus to the big elephant in the room, the Federal Reserve.
Okay.
This CPI report has everyone wondering, will they change course?
That's the billion-dollar question, isn't it?
It is.
Will this be enough to convince the Fed to pivot and start cutting rates again?
Well, what do you think? Is this a turning point, or is the Fed going to stay the course?
Let's be realistic.
Okay.
One report, even one that's slightly better than expected, is unlikely to dramatically alter the Fed's stance.
Okay.
They're looking at the bigger picture, the long-term trends, not just month-to-month fluctuations.
So they're not going to hit the panic button just because core inflation dipped a bit?
Exactly. They've made it very clear that they're committed to bringing inflation down to that 2% target.
Right.
And they're willing to stay the course, even if it means risking a slowdown in economic growth.
Isn't there a danger they could go too far and push the economy into a recession?
That's the tightrope they're walking, trying to cool down inflation without causing too much collateral damage.
Right.
It's a delicate balancing act, and they're under a lot of pressure to get it right.
So what are the experts saying?
Yeah.
What's the most likely scenario going forward?
Most economists believe that the Fed will hold rates steady at their next meeting.
Okay.
They're going to want to see more data, more evidence of a sustained downward trend in inflation before they consider changing course.
Okay.
But if we see another soft CPI print next month, perhaps combined with some signs of weakening in the labor market,
Then our rate cut might be back on the table.
they'll react to what the numbers tell them. If the data suggests that inflation is truly on a downward trajectory, they may feel more comfortable easing up on the brakes.
So it sounds like the Fed is playing a delicate game here, trying to strike that balance between taming inflation and keeping the economy on track.
Exactly. It's a bit like trying to land a plane in a crosswind.
Okay.
You need to make adjustments to stay on course, but if you overcorrect, you could end up in trouble. And then on top of all that, we've got other things that could push inflation up even more, like President Trump's trade policies.
Oh, yeah. That could make things we import more expensive. So it sounds like the December CPI report is maybe a reason to be cautiously optimistic,
Yeah.
but not a reason to break out the champagne just yet.
I think that's a great way to put it. But remember, even with that slowdown, core CPI is still way higher than what the Fed wants it to be.
Right? That 2% target they're always talking about.
Exactly. And don't forget the Fed actually uses a slightly different measure of inflation called the PCE price index.
Okay. Yeah, I've heard of that one.
And that one tends to run a bit lower than the CPI.
So even with this CPI report being a little better than we thought it was going to be,
Yeah.
the Fed probably isn't going to make any big changes to what they're doing just yet.
Probably not.
But I guess the question is, does that relief justify such a big rally?
Yeah, that's the real question, isn't it?
Yeah.
Like, it's good that inflation wasn't worse than we all thought it was going to be.
Right.
But 1 month of data doesn't mean everything's fixed. You can't celebrate too early.
Right.
And speaking of celebrating too early, did you see what happened with the 5-year break-even inflation rate?
Oh, yeah. What was up with that?
It basically tells us what the market thinks inflation is going to be over the next 5 years. And it barely moved after the report.
So even though the market went nuts in the short term, it doesn't really seem like they're all that confident about inflation going down in the long run.
I think that's a really good point. It's kind of like getting excited about one good grade when you haven't even finished the class yet.
Right.
You got to see how the whole semester goes.
Yeah, you could still totally bomb the final.
The fact that core inflation is going down is encouraging,
Right.
but it's just one piece of the puzzle.
And speaking of the puzzle, one of the articles we read had a really great quote that sums up the whole situation. It was from Omer Sharif, the founder of Inflation Insights. And he said, Good news, but still some wood to chop.
I love that. It's so true.
We're moving in the right direction, but we're not there yet. So for someone like me, what are the key things to watch for in the coming months? Besides future CPI reports, of course.
Yeah, I would say pay attention to what the Fed is saying and doing. Their statements and actions, I think, will give you valuable insights into their thinking and how they're interpreting the data.
Okay.
They've been pretty clear that they're laser focused on inflation,
Right.
even if it means risking a slowdown in economic growth.
So they're not likely to back down from their hawkish stance anytime soon.
Not unless they see convincing evidence that inflation is truly on a downward path.
Yep.
They're not going to be swayed by 1 month of slightly better than expected data.
Right.
They need to see a sustained trend of improvement.
And what about the labor market? You mentioned that earlier.
Uh,
How does that factor into the Fed's decision making?
Well, the labor market is a key piece of the puzzle.
Okay.
Right now, it's very strong,
Right.
which is great for workers,
Yeah.
but it also puts upward pressure on wages and prices.
Okay.
So if the Fed sees signs that the labor market is starting to cool down,
Okay.
that could give them more leeway to consider easing up on rates.
So a strong labor market is actually a double-edged sword when it comes to inflation.
In a way, yes. It's a sign of a healthy economy, but it can also contribute to inflationary pressures.
Yeah.
The Fed needs to find that sweet spot where the labor market is strong enough to support growth, but not so strong that it fuels excessive inflation.
It sounds like they have a tough job ahead of them.
They do, but they also have a lot of tools at their disposal.
Right.
And they're constantly monitoring the situation and making adjustments as needed.
And for our listeners who want to dive even deeper, don't forget to check out our YouTube video 2025 Stock Market. What smart money knows that you don't.
Absolutely.
It's a fantastic resource to help you stay ahead of the curve. Thanks for joining us on this deep dive.